to record the session so I can give you the video afterwards in case you need to go back and watch it again.
That would be awesome. Yeah,
Yes.
yeah, that would be fine. That would be great, not fine, great.
Okay.
Yeah, so for me, the time value of money and the way that you do these share value calculations
Yes.
and what was the other one? It's all to do with the same type of maths
Yeah, it's
or the
discounting
same
future
type of,
cash flows.
yes. So it's all to do with that in and interest rate per year and present value, future value, and payment.
Correct.
Because
Correct.
this is what you use mostly on this calculator I saw.
That's right. Which one do you have? Do you have the HP or the Sharp?
No, I have the
You've
HP.
got the HP. Okay, perfect. Yeah, that's
Mm,
what you need for the financial maths. So that's the right
yeah.
approach.
And then I've got a normal calculator. And now with this whole COVID-19 thing, it looks like um, we're going to write these things online.
Okay, which is different, but yeah, I'm not too sure. It'll be the first time that UNISA has done that. It's normally always written, but I'm sure online gives some advantages because at least you'll have your formulas, you'll have some of your notes from the textbook with you, and that. So open book can help, but you should know
Mm,
how to approach the questions, especially the practical questions. Theory, you can maybe search through notes if you really need to. I don't know,
yeah.
will they still give you a time limit to it? Will it be a 2 hour paper or will they give you a window, like maybe a week to submit?
So I've done two of these exams online and they give you about 2 hours.
Okay, so it is going to be limited in time. Okay, so then you do
Yeah.
need to know your content quite well. You can't really refer to your notes. You don't want to waste time going through notes.
Yeah. No. But that's the thing. That's why I want to get in my head. So, okay,
Yes.
like you said, if we can do it online, the test, it's going to help me with in terms of the
Formulas.
paper the formulas. So the formulas
Correct.
I can then keep next to me.
Yes, that's
You don't
good.
have to study it, but to apply it,
Yes.
that's the thing. And that's what I want to do today. So I'm struggling with on assignment two with 16 from 16 to 20.
Okay, you want to look at assignment. Let me just open it up then and then we can look at the
Okay.
questions. Okay, 16 to 20.
Mm. So I've tried everything, but I can't get to this answer. So I just want to see what I'm doing incorrectly. Oh, sorry for my dogs.
Okay. All right, let's go to. Do you know what page it's is it on?
It's page 23.
Perfect, thanks. Okay, let's go to
Yeah.
23. There we go. Question 15.
16.
16. This
Yeah.
one. Okay, so let's look at these. And I'll treat them like exam questions because you will get multiple choice in the exam. I don't know if they'll
Oh,
change the structure because if they're doing it online, maybe the whole paper will be multiple choice and there won't be any written questions. I don't know. UNISA will probably have to tell you more about the actual online paper because normally there are written questions. If you look at past papers from previous
yes, I
years,
saw.
you will see long questions as well. But now, will that change because of the online and COVID and all of that? I don't know. Maybe.
They said if you can't write this thing online, then it's going to move out to October, November. But I want to do this because I can bet you if it works now, they're going to do it in future.
Okay, yes, yeah. So I think it's a good innovation. It's good that UNISA is going that
Mm,
route. So I don't think it's a bad thing, but you just need to check with them. Will the structure of your exam will that change? Because as it stands, based on past papers, they've normally tested multiple choice, and that's quite simple to upload onto a online platform. But the long questions, so how would you complete those, and how would you submit your answers if it is going to be written? Would you have to
yeah.
do that electronically? I'm just suggesting that there could be maybe certain things that you'd have to adapt or change to, and UNISA will have to report back on that. Yeah.
Yeah. So well, I think that they will. maybe like this assignment, I have 20 questions,
All
you have
multiple
2
choice.
hours. Yeah, all multiple choice.
Okay.
You just have to work it out.
All right. Well,
And
then that's
then,
easy. Then that's actually better from a test point of
mm,
view. Yeah. Okay. So let's look at this one. Um, so these ones you were totally blank, eh?
this one, I understand that you, so if I read the question,
Yeah.
just,
Tell me what stands out
so,
because that's important.
okay.
Application.
So, yeah, so for me, D0 is 2 rand. So that is fresh. That starts at 0, if I can say it like that. That will be PV0 or T0. Yeah, okay, cool. Then I've got, so there's a rate of 20% per year for the next 2 years. So what I've done is I've taken that 2 rand, take a 20% on that, and then a 20% on that, and I got to 2 rand 40. Okay,
Good.
cool.
So timeline. Yes, that's brilliant. That's a
Yes,
good
that's
start.
what I did. Okay. Then from there it says, and then at a constant rate of 7% thereafter. So, and then it's the beta and the risk-free rate and the market risk premium, which you showed me the last time, which I've tested, but like I say, I
Got a bit stuck.
yeah, I think it's number one, but I only got to like a 39 rand or 40 rand or something.
Oh, okay.
That
Yeah.
was
So
the
a bit
closest
off.
that I've got to one of these.
Okay, well, that's not a bad attempt considering these are obviously questions that are new because you're going through the assignment. Obviously, later on, once you've covered more questions, it will get better. So, I'm going to show you how to do it then. When you read the question, everything that you've told me is perfect. Okay, you've already identified the correct, let's say, topic in terms of the question belonging to the share valuation. Okay, determining the value of equity. You've got the right formulas. You're thinking about a timeline. You're adding 20%. You've got the 7%. Okay, just a tip. I would draw a timeline so that you can see what's happening. Okay, that's the best approach. So I'm going to leave this here, but I'm going to also just draw it here as well so you have this. So I can email it and then you can just go back and look at it. Time 1,
Okay.
time 2, time 3 onwards. Okay, so right now you've got div 0, which was 2 Rand. Okay, div 1, div 2. You know from the question that there's going to be 20% growth, okay, from
Yeah.
one dividend to the next. Okay, so you had the right answers there in terms of 2 times 1.2, okay, adding 20% to div 0 to get div 1, and then doing the same thing here, adding 20%, okay, to get those answers. So those are the dividends that you've got. Okay, you still need the last dividend, and that last dividend is going to grow constantly at 7%. Okay, so if you read the question, they said, estimated that the company's dividend will grow at a rate of 20% for the next 2 years. So for year 1, 20%. For year 2, 20%. And then constant dividends, 7%. As soon as you see the word constant dividend, you should be thinking of Gordon growth. Gordon growth, PV equals div 1 divided by brackets R minus G close brackets. Okay, that's the formula.
Yes.
And that you'll have with you when you write the exam. Okay,
Exam,
so what do
yeah.
I do? Take that figure, 2.88, multiply that by 1.07 because I'm adding 7%. That gives me the next dividend. Okay, I'm going to leave it as is. I'm not going to round off the workings. I'll round off the answer. Okay,
Yeah.
are you happy with that so
But,
far?
yeah, you see what I've done is I've taken 2 rand times 20%. I didn't take it 1.2. I just took 0.2, not
That's fine. Then
1.2.
you're just doing it in 2 steps. Okay, so div 1 would equal div 0, okay, plus brackets div 0 times 20%, 0.20, close brackets. Okay, so you would have done it like this, equals 2 plus brackets 2 times 0.2 close brackets. Then you would have had div 1 equals 2 plus 0.40. You get the same thing.
Okay, okay. Yeah, but I got 2.2 and then 2.4. I see you got 2.88. You see, I didn't take the D1. I didn't do that first step. D1 equals to D0 plus that bracket. I didn't do that. I just took
Oh.
it straight 2 times 0.2. Okay,
Okay,
so
yeah.
that
The
I've done
reason
wrong.
why I'm taking it 20%, it's 20% per year for 2 years.
Yeah,
Okay, so in other words, it's 20% that year, 20% that year. Okay, so if it
yeah,
starts as 2, you're adding 20%.
yeah.
Okay, then you're adding another 20%. Okay, so it's
Okay,
20%, 20%, 7%.
okay. No, now
Okay.
I understand.
All right, then they say in the question the company's share beta is 1.2, risk free 7.5, market risk premium 4. What do you think about when you see that?
Um, share beta.
No, but what topic? What's the key formula?
Oh, what's that other
Do
thing?
you remember? CAPM.
Hey, yes, Captain. Oh, sorry.
Okay, so that's something else that we need to
I just
remember.
finished working, so I just finished work with a lot of Excel, and yeah, I think my brain is a bit morph after this.
Okay, yeah.
Yeah.
Shane, do you want to get something? Do you have some water, something with you, just to, or some coffee or anything close by? Will you be
Nah, I'll
okay?
get now. Yeah, no, I'll be fine.
All right. Okay.
I'll be fine.
If you want
Yes,
to take a
that's
5 minute
okay.
break in between, we can do that. You can grab something and then I'll wait for you and then we can continue.
Okay,
Okay, just let me know.
that's cool.
Right. So then
Thanks. I
KM,
will do that.
market return, and then risk free. Right. There's the formula for CAPM. Okay. What does
Yes.
CAPM give you? It gives you the required return.
Yeah,
Okay. The required return will be the R in this formula.
that's correct. Yeah.
That's why it's so important to remember CAPM because
Mm.
sometimes they don't give you the R and then you need to work it based on the actual amounts given in the question. Okay, happy with that?
Happy?
Good. Just remember, you need to be specific here. When they talk about a risk premium is different from a market risk premium. Remember, the one is looking at the whole bracket and the one is looking at part of the bracket. Do you remember that we discussed that last time?
Yes,
Okay,
yes.
I'm gonna open up that file from last time just to show you that consideration here. It was question 14 of assignment. Okay, we actually did this assignment question.
Mm.
Okay,
14, yeah.
yeah,
That's
there's
why
it.
I opened up the last workings
Yeah.
to do this.
Yes.
But I think it's because of that 2 rand
Oh, okay.
88
So the two
story.
rand thing
Maybe,
threw you off.
yeah,
Okay, but I just want to
maybe,
highlight that point.
yeah.
Okay, KM minus RF. So in other words, the bracket part is the market risk premium. Did they give you the market risk premium here?
Market risk premium is
Yes, they
4%,
did.
yes.
Okay,
Yeah,
so this is representing that bracket. Do you see
yeah,
that?
yeah.
Okay, so we need to substitute the 4% there. So let's do that working. Risk free in the question, what was it? 7.5. 4%, 1.2.
Yeah.
Notice I'm putting the 4 for the whole bracket
Okay.
because given the market risk premium.
Yes.
So that's important to note because that's theory that we just need to apply because of the question's wording. And then you can just work out the risk free, not risk free, the return based on the risk free and the.
I just want to ask you something while you're busy with it. So Km minus Rm. Um, sorry, Km minus Rf. No, that's your market return, market risk.
It's the market return. So basically, what the
Okay.
market would return, because remember, cap M looks like this. Let me draw it here quickly. If you look at the theory for cap M, you'll see that I discussed this in one of the weeks. I just want to mention it because it's important in terms of theory. When you look at CAP-M, what CAP-M is, it's the relationship between risk and reward, basically.
Yeah.
So if you're looking,
Yeah, I remember that.
yeah, if you're looking at risk-free, right? You've got beta. Beta is your measure of risk, and you can actually calculate beta using data, okay, statistics, right? So if you've
Yeah.
got enough data, you can use statistics to give you the actual beta. Beta is calculated in other subjects, not this one. Okay, in this subject, they'll give you the beta, they'll give you the actual risk, and then you need to relate that to the return. Okay, return is on this axis, right? And then you've got
Yeah.
risk. So depending on risk, if I've got risk at 0, so in other words, if there's no risk, where would I be? I would be here. And that would be along the y-axis. Okay, and that's what they refer to as the risk-free rate. So when you look at finance, the risk-free rate is the is the return that you will get on government securities like treasury bills. Okay, those securities are considered risk-free because you wouldn't expect a government to go bankrupt. Okay, even if you think about a country like Greece, okay, when Greece went through the financial crisis in 2008, okay, they got in such a bad situation, but they still didn't go bankrupt as a country.
Yeah.
Okay, so risk-free is this point, that point over there, that little dot here. That's the
Okay.
theory. Okay, that point is the risk-free rate. Okay, that point represents the risk-free. And in this question, the risk-free was what? 7.5%.
Yeah.
Okay, so we're saying if I had to assume, okay, no risk. In other words, if I had to put my money into the money market or if I had to buy treasury bills, okay, something that's considered risk-free, I would be earning 7.5%. Okay, you're looking
Yeah.
at was this a share? Yes. Okay, so this company, right, remember, I'm going to take a risk by investing equity in this company. And if I'm going to do that, I want to be compensated for the risk that I'm taking. Right, because why would I take a risk and get no return or less return? I might as well just keep my money in cash and let the cash generate a risk-free return, which is 7.5%. Okay, so
Yeah.
it's like keeping money in the bank. Would you keep your money in the bank and earn interest around plus minus 5%? Or would you put that money in the equity market and try to generate a higher return? Okay, if you do that,
Yeah.
then you're taking on risk. And then you're moving along the line. Right, so where are we currently? We're at 1.2 in terms of risk. So that would be here, somewhere, 1.2. Okay, let's just use that. Right, if we're looking at 1.2 in terms of beta, okay, that line is representing that point. Okay, so x-axis, y-axis.
Yeah.
Okay, we're comparing that to this diagram in terms of its corresponding return. So what is this required return? That's basically what we're saying. We're saying if I had to take on more risk, meaning if I had to invest in this particular company, this company has a beta, okay, of 1.2, meaning there's more risk in this particular equity because it's greater than 1. Okay, 1 would be market risk. So investing in like an all share index, JSE all share. Okay, the ALSI, right? That would be
Yeah.
market risk. Okay, market risk would be 1. Okay, if you're investing in a particular company, this company has beta of 1.2. Okay, 1.2 represents a risk that is slightly higher than all the other companies in the market, basically. So you're saying, if I had to invest in this particular company, this particular share, okay, how much am I going to expect as my required return? So in other words, if I had to invest at a 1.2 beta with a risk-free of 7.5%, what is that going to translate to? Well, it's going to translate to that, 12.3%. That's what it's saying.
Oh, okay.
Okay, so if I invest in this company, I have to get 12.3% to offset the taking on of more risk. Okay, but now we need to relate that to the actual price of the equity. In other words, how much should I pay or how much should I be willing to pay for this particular share based on its future dividends? That's why you need to work out the price of it.
Okay.
That's applying the rate to the dividend,
Yeah.
the discounting.
I just want to see if I've got the same answer when I did that. I just want to ask that KM minus RF now. So
Yes.
the KM was the market risk. Am I right in saying that?
No, the KM is the return. They didn't give that to you in the question. They gave you the market
Okay, so
risk premium. They gave you the 4%, which was the bracket. If you
so
wanted the
that's why you.
KM, it would have been 11.5. 11.5 minus 7.5 equals 4.
Oh,
Okay,
is
have a
that how
look at
you
how
worked
they
out
gave
that
it to
for
you.
now?
Market risk premium, 4%. So the bracket is 4%.
Okay, okay. So if they didn't give it to me, I would have worked it out manually.
Yes, so they could have given you
Oh,
11.5 as the market return, then you would minus 7.5 to get the 4% risk premium, market risk premium.
okay. Okay, now it makes more sense because I couldn't understand how did you get to 4%, but there's a
It was
minus in
given.
there. Yeah, okay.
Yeah, it was
Now we
given. That
can
was the
continue.
wording. That was the wording in the question. That's why I referred back to last time's content because we checked in the textbook. The textbook talks about the
Oh, my,
bracket. The textbook talks about the risk,
um,
the not the risk, the market risk premium as being the KM minus the RF.
okay,
Okay, so if they
okay.
talk about market risk premium, they're already giving you the answer. They're giving you the bracket worked out for you.
Minus RF. That's in the corner.
4.
Okay, now I understand.
Okay. All right, so now you're going to take that and you're going to put that into your diagram. Okay,
Yeah,
remember, copy paste this. What dividend is going to grow constantly? This one,
yeah,
div 3. Do you agree?
yes.
Okay, div
Because that's
3
from year
would
3, yeah.
would be equivalent to div 1, and then we would say div 2 would be equivalent to div 0. Does that make sense? But from the
Yes. Sorry,
Gordon
I'm just,
growth model.
yeah,
Okay, so if I'm applying this formula is applicable, okay? Div 1 in the formula is going to give me the price, the PV at time 0 for that particular dividend. So if I'm using div
yeah.
3, this PV is going to be the PV at div 2 or at time 2.
Okay,
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 so copy
okay.
paste the dividend 3,0816 divided by R. Can I put in an R? Yes, 0.123. What is the growth rate? 7%.
Yeah.
Answer? Let's check. Type that into a calculator. Calculator gives you an answer of 58.1434. Again, I'm not going to round it off. I'll leave it as is. I'll round off the answer.
Yeah.
Okay, where is this? This is at time 2. Okay.
Okay, so now I understand. So so PV is 0, the D1. So they're asking from D3. So
Yes,
then you
because that's
take,
constant growth.
yeah, then you take D2. Okay, now I
Okay,
understand.
yeah, now
Okay.
you've got to discount those cash flows, including the one that you just worked out.
Yeah.
Okay, so now we can use the calculator for this. Use the shortcuts. Okay, use the financial calculator. Use the
Yeah.
cash flow button.
cash flow button.
Yeah. Okay, I'll show you how to do this now. Let's just write it in. 0,
Okay.
1, 2. That's it. Okay, so what is year 0? 0. Okay, nothing. First
Okay.
cash flow, 2.4. Okay, year 2's cash flow. What is year's 2 cash flow? It's the R2.88 dividend that you get plus the present value of all those future cash flows from that point onwards. Does that make sense?
Sure. Yeah.
Okay, we'll work that out. Let's just write an answer here. This block plus that block gives me that cash flow. Okay, now you can do this manually where you can discount each cash flow and just add it. So if I take the present value at T0 for each cash flow, okay, what am I going to do for this cash flow? I'm going to discount it for 1 year. Okay, so PV, open brackets. The rate is, what is the rate? 12.3%, so 0.123. Okay, what N do I have? I have 1 year. Okay, no payments. Okay, what's the future value? The future value is the 2,4. So 2,4. Close brackets, that gives me that answer. Okay, then I will do the same thing here for the next thing. Okay, present value. Okay, the rate 0.123. Okay, how many in 2 years? Okay, no payment. It's not an annuity. Future value 61. Okay, I don't want to write it in because it's going to take some of the decimals away. I'm going to put that, reference that figure. Close bracket, answer. There's it. Okay?
Okay.
Then I need to sum it up. Gives you that answer. Okay, and that should be an answer in the question. Let's see. What is your estimate of the share's current price? Not there. Let's go back. Did I make a mistake with the... It's 12.3%. That's the R. Did I use the right R? Yeah, I did use the right N. I did use the right figure. 60 Rand. Did they send you any errata for this assignment?
No. No.
2.4. Yeah, it's right. Let me check it on the financial calculator. Ooh, let me just grab my calculator. Let's do the cash flow method. Maybe there's a problem with Excel, the formula. Okay, let me type it into the financial calculator. Okay, so let's go cash. Okay, what is the rate? Rate here was 12.3. 12.3.
Yeah.
Okay, 0 for the first year, 2.4. And then the next one was the 58.1433 9623 plus the 288, 288. Okay, escape, net present value solve. Okay, net present value 50.52. That's the answer I get. So I think I made a mistake with the formula here. Let's check what's wrong with the formula. Present value.
Okay, but I think you took in that 61 Rand plus that 58 Rand.
Yes, you have to. You have to discount both.
Oh, okay.
Okay, 0.243, enter. %, discounted for 2 years. On the calculator, if you solve for NPV, okay, you get 50.52504243. That's what you get. Okay, that should be an answer. Let's see. Yeah, that's there.
Yeah, that is it. Number 3.
Yeah. Okay,
I just want to work this out quickly on the calculator again. I just
okay,
want to
so
put
on
on
your
the light.
calculator,
Just
on the
hold
HP, on the
Just hold on for me
HP,
quickly, Anthony. Just want to put on the light, yeah.
okay.
That's a bit better.
Okay.
So the cash flow. Okay, so I've got the cash flow. So I put in that.
Oh, I see my mistake. Here's it. This is a payment. This should have been 0. Okay, there. Future value. Enter. There we go. That worked. Sorry, I had the wrong formula in Excel. There's the same answer.
Yeah.
Okay, yeah. On the HP, this is how you do it. Second function, clear. And then you should see a P/Y on your screen. The P/Y should be 0. Do you see that?
Yeah.
Okay. Then you need to put in cash flow. So you press 0 and then you press the CF button.
And then you press 2.4, no?
No? Okay, yeah. And then press 2.4, press CF button.
Okay.
Okay, then type in 661.0234, press CF button.
Yeah.
Okay, then we need a rate. Then type in 12.3 and then press I/YR button.
Okay.
Okay, and then you need to look for the second function. On your calculator, I can't remember if it's a red or a green button, but it's a shift button. I think it's red.
Okay, I've got it.
And then you need to press
Net present value.
the NPV, and then you should get the same answer, 50.5250, whatever, yeah.
Yeah. Okay.
Did you get that?
Yo, this is a big working, eh? I suppose it's not a big working. It feels so big because you had to explain the thing from scratch.
Yes.
But
Yeah,
okay.
so the main thing is this. The diagram is everything. That's all I'm going to be looking at in terms of working.
Yeah.
Okay, the rest is just to supplement what I've got here. Okay, once I've got
You
this
see,
diagram, then this I don't have
Yeah.
to write down. Remember, none of this you need to write down. You just need to type it into your calculator. I'm just writing it down so you've got it and you can refer back to it.
Yeah. Yes.
Okay, the only thing
But-
that I would be writing down is this, the diagram. I would be drawing that diagram and then typing everything else on my calculator.
Okay. That makes sense.
Okay, what question
That
number
makes
was this,
sense.
just so I can label it?
16.
Okay, great, thanks. Question 16.
Yeah.
Okay, what's next? 17, hey?
17. Yeah. So this one I'm totally lost. On
Okay,
this
we'll
one.
go through it. We'll look at it in detail. Let's have a look. Okay. All right. Brower Bloom has preference shares outstanding that pay dividend. Okay, when you see the word preference shares, a preference share, the word preference means that there's going to be a dividend that's going to be payable on that particular share before the ordinary share dividends are paid out. Does that make sense?
Yeah.
Okay, so when you see preference share, you're thinking of a perpetuity. All right, have you done DSC 1630, Dion?
No.
Okay, yeah. All right, you don't have to do that one. That one's not so important. If you don't need to do it as part of your degree, then that's fine. But this one course covers all the financial math. It takes what we're doing here to another level. Okay, but in that course, they talk about perpetuities. Just to give you the short answer, perpetuity is a never-ending payment. It's a payment that continues forever.
You've done something like that, or to the effect of this in one of the.
We
in
probably
one of your
have.
videos.
Yeah, we've probably looked
Yeah.
at this in one of the other questions, but yeah, a perpetuity is a never-ending payment, and that's what this is
Okay.
looking at. So when you see the word preference
Okay.
share, that's the takeaway. Okay, you need to remember that you're dealing with a never-ending payment. That's the dividend. Okay, then the formula is the same as Gordon growth, except there's no growth.
Ah.
Okay, what are they asking you to work out here? Well, they give you the dividends. Okay, they give you the preference share price. What is the shares required return? Solve for R. How's your maths? Can you solve for R?
Yes. Yeah.
Okay, go for it. Get one of the options. I'm going to type that in here.
Let me just check quickly. Okay, so it's as easy as this.
Yes.
My word.
It's just pulling out the correct topic. So the topic here, it's a perpetuity. It's a never-ending payment because it's a preference share. A preference share would pay dividends for the foreseeable future unless the company ceases to exist. What do you get? Solve for R.
Yeah. Oh, 650.
Let's check. Remember, it's division,
Okay.
hey?
Yeah. I've done that.
Okay, it's a percentage, it's a rate.
Yeah. So
Okay,
I just put in the 100.
yeah,
Yeah.
times 100. Okay, percent. That's the required return.
Awesome. Yeah, I see that maths is a bit key here in some of these things, because if you
Yeah.
don't know how to do maths, you're going to be a bit screwed. But
Yeah, but your maths is fine. You got it perfect on the dot,
yeah.
100%.
Yeah, well, I've done, not to be sounding stupid or anything, I actually did DSC 1520, and I had to do it twice because the first time I got 30%.
Okay, yeah, that's also a good
Then,
module. The 1530 is the algebra and the linear programming and
yeah,
the
yo.
derivatives. Yeah, yeah.
But
But if you manage that
actually,
on your own, you did well. It is a difficult one.
I actually got a tutor as well
Okay,
to help me. And the next time I wrote it, I got 74%. So,
nice. Well done. That's
hmm,
what you want to get. Yeah.
yeah.
Okay. Good.
You see, I'm a bit old as well, so it
Age is just a
struggles to,
number.
yeah. Yes, sometimes it feels like that, except on weekends when you don't want to get up.
Okay. All right. So 18. Did you know what they were talking about here? Like, was this okay?
So,
Were you on the right track, kind of?
okay, so I took that 150 and but I think what I did wrong here is the fact that I didn't put 1.05 maybe, because I had the share for the next 3 years, and then by 10% for the year after. So I took that 150 and I put in 5%. Then that amount, 5%, then again 5, and then 10, and then I tried to get the answer.
Okay, yeah, that's
Is that
good.
on the right?
Yeah, but did you draw it? Did you have a picture? Hey.
Hold on. I think my timeline just went down instead of across. But what I've
Yeah,
done
that's
is
okay,
I wrote,
but you need to visualize it. Yeah, that's the best approach. So
yeah,
from an exam
yes,
technique, just as a tip, if you want to get it right all the time, just keep drawing diagrams, especially for questions like this. Right, if you
yeah.
have a timeline, you can't go wrong.
Hmm.
Okay, so let's put what you have on the timeline. You tell me what to put. What am I going to put where?
So T0, so just pay the dividend. So to
Correct.
me, that is T0 1.5. Am I correct?
Yes,
Okay,
100%.
okay. And on that 150, you have to put a 5%.
Yes, so growth is 5% per year for the next 3 years. Good.
Yeah, so you have to do that 3 times.
Okay, so what amounts did you get for each of them?
You see, the first one I got 1 rand 55.
Let's check.
But
Okay, 1 rand
like
50
I just
times 1.05. Ooh,
you see, I
no.
didn't do that. Yeah.
Okay, there's a mistake there. Okay, at least we've
Oh,
identified
there we
it.
go. No, wait. There we go. So I've got three 3 times I did it here. So I got 1.575 for T1. Okay. For T2, I've got 1.65375.
Good.
Let's check if I'm correct. Yeah. Then the next one was 1.19125.
No, the last one
No,
should be 1.73.
maybe.
Just check that working
Okay.
again. Remember, it's 5% growth. So it's this question, it's this number, that number times 1.05%.
Yeah.
Yeah.
I think I skipped that one straight to 10%, and I think this is where I went wrong.
Yeah, let's check the question. Expected to grow for the next 3 years. Yeah, it's 3 years.
Mm.
Okay,
You
and
see,
then 10% thereafter. So from
yeah,
T4, you're going to have an arrow.
yeah.
And now you're going to use the 10%. Do you see that?
I think it's frozen a bit, the screen.
I can still hear you. Can you
Yeah,
see the
I can
screen?
hear you, but I think it's frozen. Oh, there we go. There we go. Okay, so you put the arrow down, okay?
Are you happy with that? What
Okay.
was the
Yes,
last
happy.
dividend?
Oh, well, then it's that times 1.10. Okay?
Yeah, the 1.90, 910081,
Okay.
10%. 10% of that figure.
Yeah. But now, after this,
Yes.
so this 5 years or is this then 4 years?
This is still 4 years because it's year 1, year 2, year 3, year 4.
Okay.
Yeah,
The
because
year
this is the
thereafter.
future dividends.
Okay.
Those
So
are the
you still
future
need to do
dividends.
number 5.
No, you don't do number 5 because from
Hmm?
that point onwards, next 3 years, okay,
Hmm?
from the fourth year. So 1, 2, 3. From the fourth year onwards, it's 10% growth. So there's
10%,
no
yes,
fifth
yeah.
year.
But there's not going to be a T5.
No, there won't be a T5. Well, T5 would be another 10%.
Okay, but okay. So I just want to
So
understand it correctly. What is expected dividend for the for the for each of the next 5 years?
yeah,
Yeah.
then
Okay.
then you'd have to keep multiplying it and multiplying it and multiplying it. So 2 rand 10.
That
Option
is an
3.
answer. Yeah. Okay. Now I just wanted to. Yo, I'm so scared I do the wrong thing, say. But if I don't try, I'll never know.
Yeah, that's a good approach. Yeah, to keep just to my only suggestion would be just to be careful. Don't rush through the question. Read the
No.
question carefully and then build the diagram and then answer it. So once I've got the diagram, so for example, I would have stopped there if I was looking for
Hmm?
PV. Okay, because then I would just discount the future dividends. But that's not what the question's asking for. Okay, the
Yeah.
question's asking for the dividend at.
No, but wait. It says what is the expected dividend per share for each of the next 5 years?
What is the expected dividend per share for each of the next? Then they should have given 5 answers here, not just one. I think maybe the wording here is incorrect. I think it should have been for the fifth year. Because if they're asking for the dividend for each year, then you're going to have this. You're going to have multiple answers.
Yeah.
Okay, you can
And
ask
that's
Unisa to confirm
hmm?
for you about that because then the answer would have been 5 dividends. Then you would have wanted to see that as an answer. There should be an option that has all 5
Yeah, okay. Now I
if they
hear you.
wanted all 5.
Yeah, sometimes the questioning is questionable.
Correct, yeah, especially with this particular module, unfortunately. Yeah, it's not the first time that we've picked up a few problems with the Fin questioning. Okay, there have been instances in the past where there have been errors, and then they've either given an errata, okay, or they've changed the question.
Yeah, maybe.
Ooh, I hear some bad interference. Are you okay there?
Yeah,
Okay,
okay. Better.
yes.
Okay.
Okay, can we move on?
We can do that.
19? How did 19 go?
Okay, so I bombed out because for me, I saw constant growth and growth at constant rate, which is Gordon growth. That I
Correct.
understand. But then I had the dividend over the R minus G. But if I look at the return, it's 12%. And if I look at the expected, the constant rate in the future, the growth is also 12. So if I do 12 minus 12, it gives me 0.
Okay, let's read the question. So you've picked up something. Let's go through it and highlight the key points. Okay, so
Yeah.
Paragon Construction current share price is 36. Okay, that's important. That is a PV potentially. Okay,
Okay.
the last dividend, D0, given in the question. Okay, in view of the company's strong financial position and its consequent low risk, its required rate of return is only 12%. Okay, that's the required rate. That's the cap M.
Okay.
Okay. If dividends are expected to grow at a constant rate in the future, and if the required rate of return is expected to remain at 12%. So this 12% is the R in the formula. So the
Yes.
R in the formula is the same as the required rate that you would expect. That's not the growth rate. The growth rate isn't given.
Oh, okay. 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 Yeah, you see.
Okay, then what will be the company's expected share price 5 years from now? Okay, so if you're looking at the current situation, you've got the current PV, okay, which is
Which is
at
of
time
36.
0, 36. They're asking you for a PV at time 5 years from now. So this is just a normal future value, present value calculation. You don't even need the Gordon growth model. Okay, so this is going to be n equals 5, I equals 12, PV equals 36. Solve for FV. See if you can do that while I write that on our notes.
Okay. Yeah, you see, I think that's what they're trying to do for people, is try to throw them off track.
Correct. Well spotted.
So, okay,
yeah, so you just need to be careful. Sometimes they're not actually asking about the present value of the dividend. Sometimes they're asking you for something that's late on in time. The key here was checking what they asked you to calculate. So they said calculate the price at time 5. And that's obviously compound growth. Future value TVM.
Okay, maybe I've done something wrong here. I get 36.21652.
Clear the calculator. Remember, with the HP, you've got to always clear.
Oh, yeah. So 36 is the present value.
Correct.
5 is the N. That's the years. 12, you see, I did 0.12. Okay.
No, on the calculator, you have to put in a percentage. Because it's I%. If you look at that symbol on the calculator, it'll have a percentage sign on it. Okay, on Excel, you've got to put it in as a decimal. If you're using this, but you won't in the exam. Well, you actually could, because you'll do it online. So maybe if you like Excel, you can maybe even use it then. But rather use the financial calculator. It's better.
Yeah. No. It makes more sense for me. But I've tried that now.
63.44.
Okay, is that what you get?
Yes.
Let me just check, because that's 36 PV.
Okay, answer's not here. Question has a problem. Oh, hold on. Expected share price 5 years from now. What else do we have here? The dividends. No, the dividend's unrelated. Yeah, it's only 36. Yeah, here's a problem. This I would raise. Let me check it on the calculator. Let's go. Compound interest.
Yeah, because I also get 63.44.
Yeah, then there's a problem with the question. Okay, 5 years from now, 12%, PV 36. Solve for future value. 63.44 is definitely correct. Yeah, there's a problem with this question. This you can raise with them. Let's read the question again. Just the required. Here, if dividends are expected to grow at a constant rate in the future, and if the required rate of return is expected to remain at that, then what will be the company's future share price 5 years from now? Yeah, 5 years from now, it will be the 36 Rand compounded to year 5. Yeah, there's something wrong with the answers. Okay. Are you sure there's no errata on UNISA, hey?
I haven't received, because...
Nothing, hey?
No,
Okay.
maybe but you know what I'll do is I'll just check this one. I'll just check if I received something.
Okay. Right, but yeah, the
Yeah.
working is correct because they've given you the share price, and they're asking you for the share price 5 years from now. Okay, there's no growth rate here, so you can't use that. There's only a required return. The required return would be the rate that you would compound this forward.
Yeah.
Right, the dividend is the last dividend they pay. The dividend is separate from the share price. The share price is what they're asking you for here.
Okay, so they put in things to throw you off track,
Yeah, but there's a
obviously.
problem here with the answers. There isn't an option for 63 and 44. There's a problem with the
Yeah.
question. Okay, this one you can definitely raise. Errata here. Okay, please check with UNISA.
Okay. Do I just send them an email?
Rather try the discussion forum. That normally works better because the emails take forever. UNISA's correspondence is not so good. I'm sure you've probably seen that from past experience. So I would rather
Yeah.
use the discussion forum because lots of students are looking at the content there. And if you raise the point, other students are probably raising the same thing.
Okay. Okay.
Okay, yeah. So I would rather use the discussion forum. Maybe send an email as well, but you're probably going to get a response sooner on the discussion forum.
Discussion forum.
Yeah.
Okay.
When does this have to be submitted?
On the 8th, 2
Okay,
days.
so they've extended the deadline well slightly from what it was previously. Yeah.
Mm.
Okay. All right. So yeah, that one we
Okay.
need to check. There's definitely a problem with the question. They need to word it better. Okay, there's something wrong here because they're asking for the share price 5 years from now.
Yeah.
That's what they've said. And that's how you would do
Yeah, and
it. You
that,
would have to compound it.
yes.
Okay, because it's 5 years from now. Unless, let's try 4 years from now. Let's try something else. Let's just see if we get anything different. Let's copy this. Okay. Let's make that a 4. Just out of curiosity. Let's make this a 4. 56, also not an option. See, there's something wrong. 56 is not there either. Okay, there's definitely a problem here. It can't even be 4 years either. Deletes. Okay, please check that one with them. Let's see what response
Okay.
they get.
And then the
Okay.
last one. Yeah.
Is this the last question? Okay.
Hmm.
Question 20. How did this one go? Feeling a bit better when you read the context? Remember, context is key. Knowing what they're testing is the hard part.
Yeah. No, this one I couldn't do.
Okay,
I just,
try. Tell me what you're thinking. Go through it. Highlight things that are important, and let's try build a timeline. Remember, the timeline is everything. If you can get that, you've done the hard parts.
okay. You see what I do, and maybe I'm just doing it incorrectly, is I read the question and then I go and see what they want at the end.
That's good.
And I think that, yeah, but I think that throws me off track because, especially like in question 19, okay, but that one is wrong. So if I look at this one, so your D0, just pay the dividend, will be 2 rand.
Okay, read the question and then tell me what should we be doing. Remember, we're drawing the diagram. So as you read the question, okay, to save time, draw the diagram as you read the question rather than read it and then do it. So read it for me and then tell me what you're thinking.
Okay. So for me, recently paid a dividend. So that means that on the timeline, 2 rand will be on D0.
That's it. Okay, see, this is
D0.
technique.
Yeah.
And
Yeah.
I would literally draw this on the actual question
Yeah.
paper, okay, or on separate paper. But what I'm doing here would be my working.
Yeah. Okay. And then from there, it's got constant growth of 5%. So that's boring grow already.
Yes.
Okay. So it's a lot of question 16 that that I see in here.
Okay, could be, but let's carry on. So, okay, you've read
Okay.
it. All right, the company has a constant growth rate, 5%. Okay, you saw that in the question.
Yeah. And a beta of 1.5. The
Yes,
required return on the market is 15% and the risk-free rate is 7%. So this will be the one that I have to work out manually.
correct. Good. So try to do that. Give me a
Ah,
cap M. I'm going to get the formula and then you
yeah.
can work it out and then I'll check it after you've done it. Let's copy this.
Okay.
Let's paste that and let's see what you get. Okay, so this one is a little bit different. It's similar, but it's different. So if you had to work this out, what would you get?
Okay, so for me, so risk-free. So I just want to retain a risk-free rate. So it is 7. Let's make it 0.07 plus the beta is 1.5. And then it is that 15, 0.15 minus 0.07. Am I
Well
correct
done.
if I say it like that? Okay.
100%. That's perfect.
Now, yeah, so now I understand that one. So that's the R in the Gordon growth.
100%. 19.
Okay. Cool.
Now what?
So now you have to go do the calculation then. Then it's that PV and
No, no,
it's
no. You're trying to do too much. Look at the question. The question's guiding you. Okay, so remember, we're reading the question. As we read something, we can write down a working. So we just read that. I've highlighted it. We've done the working. Now continue. Read the next part. What does the next part say?
okay, so there's a beta coefficient increase to
Yes.
1.75. So your beta is going to increase. Okay.
Good. So you're going to do the same working, but with a different beta.
Okay.
See, you've
And
read
then you're
it,
gonna
use it. Okay, that's the approach. 21% now.
okay. So yeah, we'll be stuck now. Not gonna lie.
Okay, the last part is telling you what you're solving for. So it says here, if the market conditions remain unchanged, okay, what is the new constant growth rate that will cause the ordinary share price of the company to remain unchanged? Right, so what are they saying that's going to stay unchanged?
A new constant growth rate. So we're gonna use 21.
No, what is the new constant growth rate? That's what they want. What's not going to change? The share price.
Oh.
Do you see
Okay.
that?
Yeah.
Okay, let's read it again. What is the constant growth rate? What is the new constant growth rate? Do you see that?
Yeah.
Okay, so let's write that down. Current growth rate, 5%. Okay, copy paste. They want to know what the new growth rate is. Question mark. Okay, what's going to happen? This is the current situation. This is the unknown situation. The only thing that we know that will stay the same from this situation to that is the share price. The share price here is the same as the share price there.
Okay.
Are you still with me? Does it make sense?
Yes, yes, it does.
Okay, so do I have the share price here? No, I don't.
You don't.
Can I get the share
at 2
price?
rand? Yes.
How?
That will be with your Gordon growth, am I correct?
100%. Good. Present
Okay.
value equals div1 over r minus g.
Yeah.
Okay, give me the div1.
So that's 2. Wait. I want to do that. 3.
Is that your answer?
Yeah. Is it 3 or is it 2?
Think about it. What dividend do you have? Look at the diagram. Div 0. Is
Yes.
div 0 div 1?
No.
How do I
So
get div 1?
yeah, so it's 2 times 1.5.
1.05.
Okay, wait.
2 times
2 times
1.05
1.0.
because I'm adding 5%.
That's 2 rand 10. Okay.
Is that 2 and 10?
Okay. Yeah.
Let's check. 2 times 1.05. 2 and 10 is correct. So this will be 2 and 10 in the formula.
Okay.
Now what?
So we first have to do for current, am I correct?
Yes, because you have enough information here. You know what the growth is, you know what the R is, and you know what the dividend is, right?
Okay.
Okay,
Yeah,
so
no,
we've
I'm
got
just
the dividend.
asking.
Give me the
Yeah.
other components.
So the R is the 0.19,
Happy with that?
and then the G is the 0.05.
Yes. Okay, good. Answer, let's work it out. $15. Now what?
So, yeah, if the market conditions remain unchanged, what's the new constant growth rate?
Okay, so let's relate this, the current situation, to the new situation. Is the price going to stay the same?
If the share price of the company remain unchanged, yes.
Good. So 15 is going to be there. Is the dividend going to change?
Well, it's going.
It will. What? How do you get dividend 1? Div 0 times 1 plus growth.
Yeah.
Okay, do you see that? More maths in this question.
Yeah.
Okay, what is the rate here? What is the R?
Okay, so the R will be 0.21.
Perfect. G we don't know. Agree?
We don't know, yeah.
Okay, now we've got an equation. We know what div 0 is. Div 0 is the 2 rand.
Yes.
Okay, now we can solve by doing a little bit of mathematics. So 2 times 1 is 2. 2 times G is 2G. Okay, so 2 plus 2G. Okay, this is divide. So we're going to multiply. Take that to the other side.
Yes.
Is that alright? Are you okay with that first step?
Yeah. Yes.
Okay, next step, multiply out. 15 times 0.21 is that answer. Okay, 15 times minus G is minus 15G.
Minus 15G, yes.
Equals 2 plus 2G.
Yeah.
Okay, how's your algebra? Can you solve that for me? Give me the next step.
Yeah, so you take take the minus to the other side, then it becomes a plus.
Perfect.
And then then it's going to be minus 2.
Good.
Equals 17G.
Yes. Let's just check that answer. Okay, plus 2 is easy to calculate. I'll just write that in. 5.15 equals 17G. How do we solve for G?
So now you have to divide.
Good.
5.15. Oh. 5.15 divided by. Yeah.
30.29% would be the new growth. Is that an option?
No.
Ooh, not there. Okay.
Uh-uh.
Something's wrong. Let's go back and check. Okay, let's read it again. Trust paid a dividend. We've got that. Trust paid a dividend.
Yeah.
Okay, the shares are in equilibrium. The company has a growth rate of 5%. Growth rate, 5%. Got that. And a beta of 1.5. We've got that. Market return, 15. We've got that. Risk-free, 7. We've got that. Let me just check this without the decimals. If it's 7 plus 1.5 times 15 minus 5, not 5, 7. Let's just see what we get. Is it the same answer? Maybe the decimals change the answer. Let's just double check. Okay, it's still 19. That's fine. Okay, the company is considering changing the policy. Beta coefficient is 1.75. Let's just check that as well this side. Risk-free 7. This needs to be 7.5. Okay, let's check the answer. This is 7.5. Ooh, there's the mistake.
It's 19.4.
7.5. How did I get this? Let me check. What did I do wrong here? 0.07 times. Oh, not times. It was plus. Okay.
But you've got plus there.
I've got plus. Okay. Multiply that by 15 minus 7.
Yeah.
What's wrong with this formula? 0.07, the risk-free 7%, plus 1.75, which is 1.75, times bracket,
Times.
0.15 is right, minus 0. Yeah, it's right. What's wrong with that? That's correct.
Okay, but let's start with the 19.4. I don't think we...
Let's just check this one. It's 15 minus 7. 7 plus 1.5. Let's check it on the calculator as well. Why are we getting two different answers for the same thing? It should be the exact same answer. This one works. This one doesn't work. Why? Let's check. Maybe this times. I'm gonna get rid of this asterisk. I still get 21.
0.
Let's put a bracket here.
Plus 1.7.
21. No, that's not working. It has to. There has to be a. There's something wrong with this. 15%, 7%. 1.75. Oh no, you do get 21. 21 is correct.
So it is correct.
Yeah, this one, that formula had to update. Yeah, 7 plus 1.75 times 15 minus, yeah, it's right. Okay, right, it was right. 21 was right. So that was correct. There's nothing wrong with that. I had to update that formula. That was my mistake. Okay, that should have been 1.75. Okay, yeah, 21's correct. Nothing wrong with that. Okay, let's read the question. The company decided to change policy will increase its beta 2. Okay, we've got that. If market conditions remain unchanged, we haven't changed anything, what is the new constant growth rate that will cause the ordinary share price of the company to remain unchanged? Okay, have we kept the share price the same? Let's check this working. Okay, div 1 over r minus g. 2 times, this was 2, yes. Times it by 5%. Let's check that on the calculator. 2 times 1.05 is 2.1. Yeah, that's right. 2.1 is there. Okay, divided by open brackets. 0.19. The 19 is the R.
Yes.
We've got the 19. We've got the growth, which is the 5. Yeah, that's perfect. Okay, let's check the answer. 2.1 divided by brackets. Yeah, the answer's fine. That working's perfect. Answer is 15. Okay, let's make the share price the same here. Okay, Gordon growth model. 15 equals, let me just write the formula above this. Okay. There's it. Okay, so it's going to be 2. 2 is the dividend, which doesn't change. It's constant. It's what we had.
Yes.
So
yes.
div 0 times 1 plus growth, close bracket, that's the numerator. That's fine. Okay, divided by r minus g. R is 21%. Do we have 21%? Yes.
Yes.
We've got 21%. Okay, let me check the arithmetic. This goes to that side. It does become multiply. 15 times the bracket minus g. Let's just check that on the calculator. 15 times 0.21. 15 times 0.21 is 3.15. That's fine. 15 times that is minus 5. That's fine. Okay, then on this side, we've got 2 times 1 is 2. Okay, this can actually, I can delete the brackets. 2 times 1 is 2. 2 times g is 2g. That's fine. Next step. 3.15 minus 2 is correct. And that becomes plus. That's correct. Yeah, our working's fine.
But wait a minute, that 3.15 minus 2, it's not
Yes.
5.5.
The 2. Oh, okay, I see. Okay. All right. I shouldn't have worked this out. Mental math. My mental math, sorry, didn't work.
It's 1.15.
1.15. Okay, well spotted. See, your math is better than mine. Okay, thanks for spotting that. Yeah, sorry, I made a mistake with my arithmetic. Okay, 3.15 minus 2, there's the problem. Thanks for spotting it. Okay, so now we should get it. Yes. Okay. Sorry, silly mistake. Made a mistake.
7.
Okay.
Yeah, 0.6. Okay.
Yeah, sorry, that's my mistake. I did the working. I added instead of subtracted.
It's good to work through these things.
All
I
right.
like it.
Is that an option?
Yes, the first
Option
one.
1.
6.76. Okay.
Perfect. Okay, we've still got time. Do you want to do a past paper, a few questions from one of them, or?
Yes. Please, if we can, if you have.
What past paper do you have? Do you have last year's past paper? The most recent one, the one they wrote in October, November.
No, but I can get it quickly.
Yeah, can you log online quick and then just email it? I've got my email open, so once I've got it, I'll put it up screen and then we can look at some workings.
Okay. Let me just open up my Unisa quickly. You see, for me, what you call that thing, my Achilles heel, I think it's still these other workings, what you call it.
The ratios.
Think of it now. Yes. Okay, but let's get a past paper.
Yeah, we'll do ratios then in the past paper. Let's do that. It'll be good to practice. We haven't done some for quite some time. I'd like to try to do the most recent past paper, so if you can get that, that'll be great, and then we can do newer past paper questions.
Yeah, so I've got October, November 2019.
Perfect. Okay, just email that to me, and then I'll put it on screen, and then we can look at it.
Okay. But I like the fact that we can do this type of tutoring. The way we're doing it now.
Yes.
I actually am working from home every single day.
Yeah, technology is really good. So the world will be different after this whole lockdown and everything has gotten back to normal as can be. Yeah.
Yeah. How long have you been doing all of this, Anthony?
Quite some time now. So this was started in 2015. So around 5 years now, actually.
Jeez.
Okay, I've got it. Came through. All right, let me just open it and then we can look at it.
Yeah, so for me the ratios is the problem. What I have spotted in your slides now is that this financial calculator, especially the top buttons, the NR, IYR, the PV payment, and the future value, can be used in 3 sections of this module.
Correct. I've got past papers up until end of 2018. Can you also send me the 2019 May June, and then I've got a complete set. Then I've got last year's papers as well. Would you mind sending me that one as well, the May June?
No, it's still open. So let me do that.
Okay, perfect. Okay, so I'm going to open this one in the meantime, and then we can look at the ratio questions. Okay.
Do you get a lot of people at this time of year that wants to do classes?
Yes, yeah. So actually, I had one just before this. That's why I'm also a little bit tired. So the student they're also crash like a crash course. They're leaving things for the last minute, and then they're trying
Mm-mm.
to cover things before the exam. So they're also writing. They're writing on the 15th. So they've literally got a week, but they've left it a bit late.
Mm-mm.
Yeah, but you're not
That's
in
why I
that
wanna.
situation, so that's
No,
good.
no, no, no. No, I don't want to do something like that.
Yeah. Okay, so I've got questions here that we can already look at. I can see that they have asked financial analysis. We can look at these ones 15 to 19, financial statement analysis, section A. Okay, that specifically covers what you're asking about. And then there's a long question here as well that we can also look at. Okay, they've
Okay.
given you long questions that you'll actually have to write instead of just choosing an option. Okay, so I'm going to start with 15 to 19. Let's see what we've got
Okay.
here. There's it. Okay. Do you
You
remember
haven't
the
got
right?
these type of. You haven't got these types of papers that's got the workings on it. Because the way that you work it, the ones that I have is from. It's red. Together we pause.
Red? What do you mean red?
No, no, the cover letter of those places. But the place's name that I got that from is Together We Pause. The
Together we pass.
but
No,
yeah.
no, I don't have those ones. I've got UNISA ones. I've got UNISA pass papers.
No, 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 but what I'm saying is it's the UNISA papers, it's got the workings on. But if I look at the way that you're doing workings and the way that they're doing workings on that sheet, it's different because they use all these kinds of heavy algebra and stuff in there.
Oh, okay. Maybe
I
they're
don't.
doing everything manually. Maybe they're showing all the
Mm,
manual steps in terms of maths.
yeah, that's what I don't want to do.
If it's multiple choice for section A, you don't need to do it a long way if you can do it the short way because it's multiple choice as long as you get to the right answer.
Yeah. Okay.
Yeah, so I'm trying to
Okay.
show you the best way to do it. So if you've got like bond evaluation, this one, calculator work. This one,
Yes.
calculator work. This one, calculator work. Okay.
Yeah.
Financial statements, calculator work, but not financial calculator work. Normal arithmetic on your scientific calculator. That type of calculator work.
And then time value of money is obviously calculator work.
Yes,
But
and
that's what I'm
that's
saying.
those are the nice questions. Yeah.
That's what I'm saying. The ones that I have, I don't know the place. I just know that on the front cover it says Together We Pause, FIN 2601.
Okay, it might be a different institution's support
Yeah, it
material.
is. Yeah,
Yeah.
it is.
Yeah, so I guess different people do it differently. So maybe that's a resource that someone has given you, so you can use that. I mean, all resources can be valuable. It just depends on does
Yeah.
it work for you? Are you understanding the calculations? Are you getting to the right answer? That's the main focus.
Yeah. Yeah,
Okay.
that is my thing.
Yeah. All right. So let's have a look at the first one. Okay, these ones, I'm just going to go and open up the notes just so we can get the formulas because we'll need them.
Yes.
Okay, that's in your second set of notes, so week 2.
Yes, in something like this you can't leave until last minute.
Yeah, practical subjects are difficult to cram. You do need to practice for them. So you'll see if you've done enough questions, if you can go through more past papers, more questions, and if you can just practice, it'll actually be better. You don't have to study for the exam. It's more practicing for the exam.
Yes. Yes, I've noticed that.
Okay, all right, there's the right file. All right, so the first question. Okay, you read it. You tell me what formulas we're going to need.
Okay. I see your PC is doing the same as mine. It's hanging.
Yeah, I've got a few things open in the background, that's why. And I'm also
Yeah.
recording the video as well, so I can send it to you
Oh,
later.
that's true. That's true.
Okay, what formulas do we need? Read the question for us.
Wait. So the question, yes, now I've closed that past paper.
It's fine. It's on screen if you need it.
Is it on screen? Okay. Okay, so at the end of the year, the average, what is the average payment period? Annual trade and other payables.
What's the first formula? The one that you read here. Average payment period. If you go to your notes, you'll see it here. Average collection, average payment. There, copy paste.
Okay. I just want to close this door because these dogs are working on my nerves. I'll be back. Just give me 2 minutes.
No
Anthony.
problem.
So it's the average payment period for that question. Will that be
100%.
all? Will that be all?
Yes, so when you read the question, you're looking for ratios that you know from your notes in terms of textbook content. So when I read this, you'll see the only thing that stands out here is this, the average payment period. So
Yeah.
now you know exactly what you're going to be using. Right, then we need to
Yeah.
substitute. So the APP equals, do I have trade and other payables? Well, trade and other payables is given as 382,000
Okay.
divided by open brackets. Have I been given the annual purchases? 1,461,600. Okay, divided by 360, close bracket, equals. Right, that you type into your calculator. Okay, option 4.
My word. Okay. So in the assignment questions that we had, they have, what they'll do is they'll cram about 3 to 4 of these type of things in, but in the exam, they give you only one.
Well, we might get difficult questions later on. We've just looked at the first one. That's a nice start.
Yeah.
Okay, it might get more complicated later on, but we'll have to see, okay? All right, let's do the next one. Okay, T Limited reports on the following data. Okay, see, exam technique. This is what I would do if this was the exam paper. I'm reading the question and I'm pulling out formulas. The first one is a formula. Total asset turnover. I know that's an equation because I've studied it. Copy that, paste it down, and then you can start using the working paste.
Yeah, so that's sales over total assets.
100%. Okay, and you won't even need to study these formulas because you'll have your notes with you because it's open books. That there is an advantage to this. You can do what I'm doing now. Copy paste. Okay, annual sales, not a formula. Total liabilities, not a formula.
Not a formula.
Okay, let's work it out. They want to know what the company's debt ratio. That's a formula.
Okay, but your total, so you've got your sales versus the over total assets. There's total liabilities.
Okay, yeah, so exam technique is important. Okay, first thing to do, look for formulas. I've looked for formulas. I've got 2. I write them down. Okay, now I go back to the question. I read the question again and I substitute things that I know. Total asset turnover, 0.85. Sales, 3074. Okay, divided by total assets, I don't know. Right, do I have enough information here to work out my total assets?
Yes.
Yes, I can solve. Okay, using algebra. Okay, take everything to one side. Total assets becomes...
Didn't you times it?
No, the total assets goes to the left. The 0.85 goes to the right, so it's divide.
Oh, okay.
Do you see that? Okay, let me do it this way. I'll do it on the next line, like this. Make sense?
Yes.
Okay. Then I'm going to type that into my calculator, and I'm going to get total assets of that answer. Okay, how do my total assets relate to my total liabilities? Do you know?
Total assets relate to total liabilities. Okay, but if you have the total... Wait a minute. I'm just thinking quickly.
How good is your
Okay, so but
accounting?
you... Oh, well, got
Counting
50%
equation?
for...
Do you know what that is?
Yeah, that's A equals assets. No, A.
Think about
Total
assets that you
liability.
own.
Yeah, yeah,
Okay, assets
assets.
are financed. How do you finance your assets? You either use your own money or
EL.
somebody
I
else's.
know, I know it's A equals E minus L.
A plus L.
A plus L.
Okay, yeah, this is part of financial management. If you look at this formula, think about your assets. So your house, your car, everything else that you own. Okay?
Okay?
How do you buy those assets? You either finance it through equity, so in other words, savings, or you finance it through liability, so the bond, okay, or the vehicle asset finance, that type of thing, right? Okay, so that's how you can remember the formula. How do you buy your assets? Debt or equity?
Yes. So it's not minus.
It's not
I
minus.
know
You can rearrange OE equals A minus L. That's the other formula.
okay,
Okay, but now I'm
okay,
just
I
applying
understand.
algebra. I'm taking the
Yeah.
liabilities to the left. Are you with me?
Yes.
Okay,
Yeah.
make sense?
Yep.
All right, perfect. Okay, so what do I have in the question? Let's go back to the question. Here, this one. Okay, what do I have? Liabilities. What do I need? Debt ratio.
Yeah. So
Okay,
that you've
I
got
actually
total
have everything. I
liabilities.
don't even
Total.
need the
No,
equity. I didn't need the
you
equity, no.
don't. You
Yeah.
don't.
So you could have just done it in one step or two steps. Total
Yeah.
liabilities divided by total assets. Total liabilities 1643. Total assets 361647.588 equals. Okay, let's work that out. Let's take the 1643 divided by that answer that we worked out. Okay, times 100. Is that an option? Yes, option 2.
Just on while the screen is just refreshing. I see it's hanging a bit.
Okay.
Okay, there we go.
Are we okay?
Yeah. Thanks.
Perfect. Okay.
Okay, so yeah, there was two ratios that you had to work with.
Yeah, so see, now they're
Okay.
getting a bit more challenging. Yeah, we've got two now
Yes.
instead of one.
Yeah, you just need to read these things completely. Debt ratio and total assets turnover. Okay.
Happy with this one? Okay,
Yes,
perfect.
thanks.
Question 17. Right, as a short-term creditor concerned with a company's ability to meet its financial obligation, okay, to you, which one of the following combination of ratios would you most likely prefer? All right, so you've got options. So if you were looking at doing business, okay, and you knew that there was a creditor that had these ratios, which ratios would you prefer?
Okay.
Current ratio. Let's discuss it generally and then we can look at the options. Okay, do you want your creditor to have a higher or lower current ratio?
What will happen if it's so your current ratio is your assets over your liabilities?
Well, it's short-term assets and liabilities. Current ratio
Yeah.
refers to liquidity.
It's current.
Yeah, so
So
liquidity is looking at the ability to meet obligations.
yeah.
Right, so if you're
So then
thinking from a business point of view, do you want a creditor that can meet their obligations?
Yeah.
Okay,
So
so
I suppose then a 2.5 would be better.
yes, okay, so this would be a
Yeah.
higher
Yeah.
current ratio
Yes.
Better. Okay, so immediately you can cross out number one. Number one's not even an option.
Yeah.
Okay, you are going to want a current ratio greater than 1. Right, that shows good liquidity. Okay, 1 is not ideal, but at least we would accept it. Okay, makes sense so far.
Yes, it does.
Okay, good. Right, then let's discuss times interest earned. Okay, what does that ratio represent? This represents the ability to cover future interests. Right, so times interest earned, if you go look at the formula, you're basically taking your earnings and you're comparing it to the interest expense that you have.
Yes.
I can show that to you. We've got the formula here.
Yeah.
Okay,
It's
do you want
EBIT.
this to be higher or lower for your creditor?
For me, it should be higher, isn't it? 1.5.
Correct. Yeah, you want it to be higher. So again, higher is better here. Higher times interest earned, higher tie ratio better. Okay, the creditor can more easily cover their debt. Does that make sense?
Yes. Yes,
Good.
it does.
Okay, and then the last bit, debt ratio.
Now, that one you want to be low.
Why?
Because you don't want a debt of 0.71, because it means then it's creeping up on your assets, your liabilities.
Correct. So in other words, the debt ratio is a measure of over-indebtedness.
Yeah.
Okay, so if a debt ratio is very high, that's very risky. So you'd want a lower, not a higher debt ratio. Does that make sense?
Yes, it does.
Okay, so which option are we going with?
Then it will be 0.33.
No, but you need to look at all of them because it's a combination.
All of them.
All right,
Okay, then it will be
like
number
it's like
2.
when you chose your wife, you've got to take the good and the bad.
Always.
Okay, so you're taking the good and the bad. So same with
Yeah.
this. If you're choosing a creditor, you're going to get the good and the bad. So which one are we going to choose? 1, 2, 3, or 4?
Then it will be 2.
Perfect.
For me, it will be 2.
100%. Option 2 would be best, taking everything into consideration.
Yes.
Okay, 18. Okay, this is theory. That you could probably answer. All right, remember the tip is, as soon as you see a ratio, you write down the formula.
Yeah.
What is the current ratio? That one you should even know. That's the easy one.
Yeah, well, that's current assets over current liabilities.
Correct. Good. Right, so which one of the following is likely to increase the current ratio? Would long-term debt affect the current ratio?
No, because that's long-term. It's not short-term. It's not current.
Correct. Next one. Would an increase in accrued liabilities affect the ratio?
I think so.
How will it affect the ratio?
Because it's going to increase your liabilities.
Which one? Numerator or denominator?
Sure. No. Which one is the top one again?
Numerator's the top. Numerator's the current assets. Denominator's the current liabilities.
Okay, then it's going to be the denominator.
Correct. So if you increase your accrued liabilities, you're going to have more current liabilities. If you have more current liabilities, you're going to have a bigger denominator.
Yes.
If you have a bigger denominator, you're going to have a smaller answer.
Yeah. So, okay, so it won't be this one as well.
Okay, yes, this one's incorrect. It would decrease your current ratio.
Yeah.
Next, increase accounts payable. Same debate. Accounts payable
Same debate, yeah. It's
is
money
the
that's
same
going
thing.
out.
Current liability. So I could just replace the first part.
Yeah. Okay.
So it must be 4, but let's see why.
Because it's going to increase your numerator.
Very good. Increase in accounts receivable. Okay, what does that do to the formula? More current assets, bigger numerator, bigger answer.
Yeah, that makes sense.
Option 4. Perfect. Happy?
Yes.
Great. Okay, 19. Here's a ratio question. What's the formula? What are we going to write?
Earnings per share.
Very good. See, you've already spotted it. See, that's the key. Right. There's something else that we need to consider. What else do we need to consider?
Isn't it that preference share dividends?
No,
wait,
not
the
quite.
tax.
It could be a consideration. What else should we consider?
The tax.
Yes, before tax, after tax. Okay, so sometimes if this question was a bit more difficult, they will give you before tax. Then you've got a minus 28% tax for the company. Okay, but it's not the case here. They've given you after tax, but that's something to note as well. Profit after tax or before tax. Okay, sometimes they even give you EBIT. Remember that? Earnings before interest and tax. And you've got to less the interest and the tax.
Yeah, but that's when they ask to do that, eh?
Correct. Yeah. So I'm raising some points just for other questions.
Yeah.
For this one, it's not important, but for other questions it might be. But you should be thinking about those things when you see those words there. Okay, profit.
Yeah.
You should be thinking about EBIT. Okay, they could have made this question more difficult by asking you to work out this first part.
Yes.
All right, but they're not asking you for that, so that's great. That can help us. Let's just copy the formula. There's the EPS. Okay, can you work it out? Do we have profit for the year?
We don't have profit for the year.
We do. What is the profit for the year? The profit after tax.
This is the one that I'm struggling with. Just say again, sorry?
The profit for the year is the profit after tax.
Oh. Okay.
Because think about it. If you've reached the end of the year, what profit do you disclose to your shareholders? The profit before tax or the profit after tax?
Well, that would be the profit after tax.
Correct. Okay, so the profit for the year is the 79,950. Is there a preference share dividend in this question?
Yes.
Good. Okay, how many ordinary shares did we issue?
8605.
Good. Type that into your calculator. Answer 7.55 if you round off. That one's perfect.
Yes. Yeah.
Okay, good. All right, so the trick is always getting the right formula, identifying what equation I've been asked to use as part of the calculation. If you can do that, you can do any question.
Okay.
Okay, let's see. Do we have more ratios here or do we need to go to the long question? Okay, that's time value of money. Let's go to the other ratio questions, which is part B, the written.
Yes, please. Yeah.
Here's it.
Because those ones will be a bit more difficult.
They could be. This one looks like a big question, but it's probably broken up into sections. Okay, from what I can see here, you've been given financial statements. Okay, can you interpret these statements correctly? Are you comfortable reading these statements? Like, can you see that the current assets here, okay, comprise of those three figures? Is that all right?
Yeah, that's fine.
Okay, and you can see that the non-current is this. And if you add the non-current and the current, you're going to get the total.
Yes.
All right, so it's just application of information, that's all. Okay, then you've got liabilities here on the right. Okay, those would be liabilities, and there's the equity. Okay, we know that the equity and the liabilities, let me just get my writing pens here. Okay, the assets, okay, equal the owner's equity plus the liabilities. Okay, there's the equity, there's the liabilities. Okay, there's the whole financing debate again. How do you buy your assets? Assets are financed through your own money or through someone else's. That's how you finance your assets. Okay, and that's what we've got here. This is for Pro Money Limited, company number 1. Company number 2, Finance Jar Limited. Same thing applies here. Current assets, non-current, total. Liabilities, equity, total. Okay, I'm interpreting the information. So when I look at a question like this, I'm scanning it, I'm looking at it, and I'm trying to interpret it as best as I can. Okay, then I look at the required. Okay, well, before the required, we've got more. Pro Money, Finance Jar Limited. Okay, here's operations, ops. Okay, we're looking at income and expenses. They've listed all the income and expenses. They've given you line items for profits. Okay, before tax, before interest, after tax.
That's actually nice.
Yes, okay, they've given you lots of information. And now, 1.1, conduct a DuPont analysis. Okay, here's a nice question. DuPont, here's a bit of revision. If you don't remember DuPont so well, I'll help you with some revision here. Okay, DuPont looks at return on equity. Okay, return on equity can be broken up into different components. Right, total asset turnover times the net profit margin, okay, times the financial leverage multiplier. Okay, that's DuPont, ROE. Okay, if I go to your notes, I just want to show you the expanded version here. Okay, this DuPont formula, this ROE, you can break the first two components, the NPM and the total asset turnover. You can break it up into that formula. Return on assets, net profit margin times total asset turnover. So you just need to remember that that first component can be broken up further if you need to do more complicated calculations. All right, but there's the formula that you can have with you when you do your online assessments.
Yeah.
Okay, so I write that down. I've got it. Okay, now I need to look at the question. The question says ROE, okay, there's the ROE, can be broken up into the ROA times the FLM. What is the ROA broken up into? The net profit margin and the total asset turnover. This is a really nice question. Okay. Return on equity, return on assets, financial leverage multiplier. They've just identified what those acronyms stand for, so that's fine. Finance Jar. This was for Pro Money Limited. Okay, where's the required? Here. Oh, that is the required. That's 1.2. So what did they say here? Conduct DuPont analysis on the financial statements. There we go. Okay, so you're basically analyzing each of these. So let's do that working. Okay, I'm going to write a heading here. Pro Money. Okay, you've written down ROE. We've got that. That's the first block. That's block number 1. I'm going to write here block 1.
Okay.
Okay, next block. Block 2. ROA, FLM. ROA, and we know that's net profit margin times total asset turnover. Okay, FLM, we're going to have to get our formula. So FLM, this is block 3. Okay, go to my formula sheet here. Total assets over ordinary shareholders' equity. See, it's this last component. Total, was it assets? Yes, total assets over shareholders' equity. Okay, that's FLM. Right,
But
then
this
we
is
need
basically
to look.
just to test if you can read all of these things. What's like, doing this in brain.
Yeah, you just need to apply the formulas. Net profit margin, profit for the year, divided by sales. Okay, no pref dividend, unless there's one, then you'll include it. What is the other one? Total asset turnover, sales over total assets.
Yeah.
Okay, so there's the first block, and that's the block for pro money. I can copy paste this later when I do the other one. Okay, so we need to start at the bottom, and then we need to move up. Okay, so let's go to our question. We're looking at pro money. Here's pro money. Okay, anything here that we need? Yes, total assets. Okay, wherever total assets are, we're going to substitute it in here. Total assets, 36031230. Here's total assets, copy paste. 3603123. Equity, I've got it. There's the equity. Okay, equity is retained earnings plus preference share capital. Those two figures.
Yeah.
So in brackets, 1141 plus 619, close brackets. Right, I can already work out this one. I've got enough information. Answer. Okay, there's the answer. Okay, total assets I've got divided by the shareholder equity plus, well, the shareholder equity, which is the retained earnings plus the preference share capital. Okay, happy with that first one?
Yes, happy.
Okay, let's continue. We need to scroll further down. We need profit. We need sales. Okay, we need other things. Let's go down. Here, pro money. There's pro money.
Okay.
Okay, what are my sales? Wherever I have sales, I can substitute. Okay, there's sales. 3074. That's the sales. Okay, do I have profits? Yes. Profit for the year? We've got it.
2 to 7.
Yeah, there's no dividend here for the pref shares. Do you see that? Okay, there's no preference share dividend here. There was preference shares. Have a look. Preference share capital, but they didn't give you a percentage here in the question.
Okay, so if they gave you a percentage for that?
Yes, then you'd have to work out the preference share dividend. Let's say if it was 5%, then you'd have to work out 5% of that. Or 5% of that. Okay, but there's nothing in the question, so I can't assume a preference share amount. Okay, and there's no preference share here either. And there's nothing mentioned here at the bottom.
Okay.
Right, and that's it. We can complete it now.
So,
Copy,
so it will say preference share dividend.
It needs to say preference share dividend, or they need to give you a percentage to work it out.
Okay.
Either or.
Yeah. Okay.
Okay, there's my answers. Right, so I've got more answers there. Okay, I'm going to use those colors. Okay, those two. Remember that diagram had a split, okay? We've got block 4 and block 5 that make up that block.
Yes.
Okay, so let's work it out. ROA equals 0.073845 dot 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 times 0.8531 dot dot dot. Okay, ROA equals, okay, I'm going to use the actual answers. I'm going to use that and I'm going to multiply it by that. Answer. There's the return on assets. Got that?
Yes.
Okay.
Okay.
Where do I need to use this? In this formula. Copy, paste. ROA is financial leverage multiplier times ROE is the financial leverage multiplier times the ROA.
Okay. Yeah.
Okay, so now I can work that out. Answer from before, 0.063. 2.0471. ROE equals that answer times that answer. Okay. And that's what you're doing.
Then you have your ROE complete. So that's the
Yes.
first one for Pro Money done then.
Correct. Yeah, then all I'm going to do is literally take this whole diagram, copy it, paste it. I'm going to replace this with the other business, which was finance jar. Okay. And I'm going to replace the numbers. All right, so let's go get the figures. Finance jar starts here. Okay, so I need to put in, there's finance jar. I need to start at the bottom. Okay, assets first. Let's replace the assets. Here, the assets. 327. Okay, assets
Zero.
need to be
Yeah.
replaced.
Yes.
327. Okay, the equity needs to be replaced. 1012 plus 914. Okay, that part. Retained earnings and preference share capital.
Yeah.
Right,
Can you
new
maybe just
answer.
put that? Can you maybe just put that shareholders' equity? So shareholders' equity is retained earnings.
Well, in this question, it's the equity that's underneath here.
Hmm. But it says equity then.
Yeah, that's the equity that they've provided you with. The retained earnings and the preference share capital. Oh, okay, I see what you mean. You're saying, what does this entail? Okay, so
Yeah.
equity entails both of them. What does the formula say? Oh, okay, ordinary shareholder equity. Good point. All right, so
Yeah.
I need to correct this. Okay, remove the preference shares. Don't include the pref shares. I see what you're saying. It's a good point. You're right. Okay, you wouldn't include the preference shareholders in the ordinary shareholders equity. I need to add that word.
Yeah, because
You're right.
it's going to make deurmekaar.
Correct. So we just need to update that. Delete. Okay, and then the formulas will change.
Okay.
Okay. This would be 3.1. Just need to update that formula. 3.15. Okay. All right. So the financial leverage will change. The rest is still fine. Okay. Same thing here. So this was pro money. No, finance jar. Okay.
Finance jar, yeah.
Yeah. Same thing. Ordinary shareholder equity. Okay. Remove the preference shares. Solve for the answer. What was the amount? Okay, let's just check if I've got the right figures. 1012, that's correct. Total assets, 327, that's correct. So answer is okay. That's the answer. All right, and then that'll be the financial leverage multiplier, which we would then multiply by the ROA, which we need to solve for.
Yeah.
All right. This you can probably look at later on. I might be doing it a bit fast now just to try finish it. So at least we have done the question. So you have an answer. You have a solution for it. Okay. So we've got that. Let's see. What else can we substitute in? We need to go down. Here, sales we can substitute in. Finance jar is what's on the right. It's this side. Okay, so where's my sales? Here's my sales. In this formula, we need to put in sales of 2567. Okay, sales here, same thing. 2567. Right, scroll further down. Profit for the year, it's on this side, 148. There's the profit. This figure needs to be 148. Okay, then we've got the net profit margin. We can calculate that.
Yeah.
We've got the total asset turnover. We can calculate that.
Yes.
Right, then I just need to update these workings. Okay, the net profit margin is 0.0576. The total asset turnover is 0.785015, so on. Okay, the new ROA, is it referencing the right formula? Yes. Okay, that's the new ROA. Okay, then to
Okay.
get the ROE, you're going to take your ROA, which is 0.045259, and I've got my FLM, which I've got in the question already. Okay, and then my ROE is going to be that multiplied by that.
Yeah.
And then you've got finance jar. Okay, so we've done the exact same thing. What we did for Pro Money, we did for finance jar. We're just using the correct amounts from the information that was provided. Does that make sense?
With the ratios.
Yes, with the correct
You see
formulas. Yeah,
that?
the formulas all
Yeah.
stayed the same. We just had to update the formula, the actual amounts.
Yeah.
Okay, yeah, so not
That
so bad.
helps.
Yeah, you can always redo the past papers and then you can just see if you get the same answers. All right, let's just
Yeah.
finish question one and then we've done the ratios in this paper. What else is there? Okay, there's a few other ones. Number 9, not number 9, number 1.2, October, November 2019. Based on the DuPont analysis of Pro Money and Finance Jar, highlight the major difference between the two companies. 5 marks for doing that. Okay, so this is theory.
Yeah.
1.2, Pro Money, Finance Jar. Okay, ROE, ROA, what else did we have? FLM, NPM.
So you need to write all of these things in there.
Yeah, I'm just going to reference those figures. So Pro Money, ROA, FLM, NPM, total asset turnover. Okay, for Finance Limited, ROE, ROA, FLM, NPM, total asset turnover. Okay, make those percentages. All right, this one's not a percentage. Okay, and then we can comment. All right, so let's compare. So, which is better here? Pro Money. Which is better here? ROA. Which is better here? Leverage. So Finance Jar has more financial leverage, so that's a benefit for them. NPM, benefit there. Total asset turnover, benefit there. All right, so here, Pro Money is better. Pro is better, Pro is better, Pro is better. Here, Finance is better.
Just in that one.
Yes. Okay, better leverage. So in other words, their leverage is greater. They can do more. Right, because remember, financial leverage is going to affect your return on equity.
Yeah.
Okay, so ROE is impacted by the separate components. Right, and each component will contribute to the ROE. So ROA will affect, so Pro is better because ROA will impact positively on ROE. The better your ROA, the better your ROE. That's how we can see that Pro Money has a better ROE because ROE is what we're looking at as at the high level. Okay, so you're looking at who's the winner and loser here in terms of, is Pro better than Finance? Which one's better? Pro is better than Finance because more of their components, ROA, NPM, total asset turnover, more of those components contribute favorably to the overall performance of the business.
Okay,
and you can obviously elaborate further if you want to. I'm just going to write this in as well here. NPM affects positively on ROE. Total asset turnover affects ROE positively. Okay, that's 1.2. So for 5 marks, you'd be discussing these 5 ratios.
Okay, that makes sense.
Okay, differences between the two companies. Right, they've given you lots of space, so try write as much as you can. If it's online, you're probably going to have to type this somewhere. Okay, and then calculate the following ratios for pro money using the above financial statements. Okay, now you need to do more ratio analysis. They've given you ratios for 2018. They want 2019. Was this for 2019? Let's go back and check. Finance jar. Finance jar. Where's the dates? They didn't even state here 2019, hey?
Oh my word.
Okay, they should have said for 2019 year. Okay, there's no date here. I don't see a date anywhere.
Okay, so then that means it will be for 2019.
Yeah, you'd have to assume it's for 2019 because that's the only information you have. Okay, so let's quickly...
But I'm okay. I'm okay with that.
All right. You think you can handle
I
that?
feel this one I can handle. Yeah.
Okay, what I'll do for you is I'll do these answers here. I'll give you an answer for that. I'll include it in the Excel spreadsheet and then I'll send it to you and then you can check it when you have time. Try do the ratios and then just confirm if you've done it correctly. Let's just see what else do you have here. Okay, this is just a conclusion. Okay, regarding the ratios from 1.3 in terms of liquidity, debt ratios, and that's it. Okay, so this is the theory that you would discuss. So liquidity would look at your ability to pay your obligations, okay, which we spoke about. Okay, remember liquidity is can you cover your short-term obligations?
Yeah, which is your current
ratios. It's all of these. It's current ratio, quick ratio. Okay, that would talk to the short-term liquidity of a company. Right, and then you would have to comment on, I think they're referring to 1.4 here, not 1.3.
Yeah, so
no, 1.3 is actually right. Yeah, 1.3
right,
is being discussed in 1.4, yes. Yeah.
So for the debt ratio, the higher the debt ratio, the worse off the company is.
Well, it's not worse off. It's just different. Okay, remember debt ratio just means how much debt do you have? How much liabilities do you have? So in other words, how over indebted are you? Over indebtedness. Yeah. Okay, so you might have a situation. This is person A, this is person B. Okay, person A has assets of 2 million. Person B has assets of 2 million. But liabilities here. Okay, liabilities might be 1 million there. Okay, for B, it might be 100,000. Okay, in terms of debt ratio, who has the higher debt ratio? A has the higher debt ratio than B. B has lower debts. Okay, so what type of person are they? They're more conservative. They don't like taking as much debt. Right, here they're more aggressive. Some people don't mind being in lots of debt. Some people do mind. Okay, so don't view it as being good or bad. Okay, it's relative. Okay, so a 36.8% debt ratio, depending on what answer you have here. Let's assume the answer is 40. I'll give you the answer when I send you the spreadsheet. Okay, I'll do the working and I'll send it to you. Okay, assuming it's 40%, that just indicates that the company has been more aggressive. They've taken on more liabilities from last year to this year because maybe they're financing more projects because they're wanting to expand. Okay, maybe they've bought more property. So to finance their assets, they had to take on more debts.
But that is the type of things that they will be looking for in the exam.
Yes, when you look at conclusions.
So, yeah.
Correct. Okay, that's applying the theory. That's looking at 36 to 40. Maybe it goes down. Okay, I don't know what the answer is, but I'll get it for you and you can compare it. If it's lower, then you can consider that. Okay, why do you think it's lower? Maybe they've paid off more debt because the interest rates have fallen, so now it's easier or it's less of a burden to pay off your debts. Okay, there's a lot of things that you can conclude.
Yeah. And the liquidity ratio is obviously linked to the current ratio.
Yes,
so if
liquidity
your current
is short
ratio,
term. It's this one. It's those two. Debt is the long term. Debt would be this one there.
Yeah.
Yeah, so liquidity is short term. Debt is long term.
Okay, now that makes sense.
Okay. Yeah, I'll put a few notes and then you can have a look at them and you can see how that goes. Okay.
That's awesome.
All right, perfect.
Anthony, thanks a lot for the help.
Yeah, pleasure. Thanks for Thanks for letting me have an opportunity to assist you. I can see you're very good with your numbers. You know how to apply it. You just need the right approach. That's all. So my biggest tip for you would be to go
Yes.
through question papers to see if you can cover more questions, and if you can get the questions right, you're on the right track.